Yes, now question 30 to 40. Now question 30 states that use the following information to answer question 30 to 35. Ricky Limited is planning to issue 10 million shares. Ricky Limited is planning to issue 10 million shares of 0.5 per value with the current market price of 2.25 cumulative dividends. An annual dividend of 0.25 shillings has been proposed. The company earns an accounting rate of return on equity of 10%. The company earns an accounting rate of return on equity of 10% and a dividend payout of 40%. The company also has 12% of 1,000 shillings redeemable debentures with a nominal value of 9 million, trading at 1,200 shillings. The debentures are due to be redeemed at par in 10 years' time. Assume a corporate tax rate of 30%. Assume a corporate tax rate of 30%. Calculate the growth. Question 30. Calculate the growth rate in dividends. Calculate the growth rate in dividends. Now, we have been given that rate of equity, return on equity is equals to 10%. From the question, we have been told that the return on equity is 10%. Then the dividend payout ratio equals to 40%. So the formula of growth rate, we are going to use the formula of growth rate. Let's have this formula of growth rate, that is G equals to growth rate equals to return return on equity times 1 minus dividend payout ratio. Now, in terms of calculation, here, now the growth rate equals to the return on equity. We have been told that is 10% times into brackets 1 minus dividend ratio, that is 40% or 0.4%. So this is 10% times that is 1 minus 0.4, that is 0.6, which is equals to calculation, that is 0.1 times 0.6 0.1 times 0.6, that is 0.1 times 0.6, you will get 0.06, which is equals to 6% in terms of percentages. So that is 6%. So we are being asked to calculate the growth rate of dividends. The growth rate will be 6%. So this reflects the balanced growth achievable for an investment of 60% of earning at 10% return on equity. Then now, 31. Calculate the cost of ordinary shares. Calculate the cost of ordinary shares. Now, for us to calculate the cost of ordinary shares, which is equity, we use the dividend discount model since the shares are trading their cumulative dividends, which means that the price includes the upcoming dividends. So, the dividends, dividend discount model, or the DDM, is that keeps the cost of equity equals to dividends 1 divided by the market price minus the current dividends plus the growth rate. So here, okay, if I can take you, key is the cost of equity. That is what we are looking for. D0 we are looking, these are the current dividends. The price here, this is the market price, and the growth here, this is the growth rate. The growth rate in dividends. So for us to get D1, D1 equals to D0 times 1 plus growth rate, which is equals to, now D0 from the question, our current dividends, we are being told they are issued at 0.5. So if we have current dividends, that is 0.25. If we are talking about the market price, we are being told the current market price is 2.25 shillings. So the market price is 2.25 shillings. The growth rate we found it to be 6% from the above questions. So we are looking for the cost of equity. So if we take that, our current dividends, that is 0.25 times 1 plus 0.06, that is equals to 0.25 times 1.06, which will be 0.25 times 1.06, that is going to be 0.265. That is we get our D1. Let's create some more space here. Then now let's go step by step. Now to get the new okay. So we have our D1, we have our market price, we have our current price, we have our J. So for us to get our KE now equals to the new calculator 265 according to the formula 265 divided by the current market is 2.25 minus 0.25, 2.25 minus 0.25 plus is it plus 6%, that is 0.06, that is 6%. So what we are going to get here is 0.265 over 2 plus 0.06. That will be 0.265 divided by 2. That is going to be 0.132, 1.325 plus 0.06. That will be that is 0.3 piece. That is going to be 0.1925, or that is, if you let's quantify it to percentage, that will be 19.25%. So 19.25% is our answer. So if we are calculate the cost of ordinary shares, option B is the answer, the right answer, 19.25. Now question number 32, calculate the cost of 12% redeemable debentures. Calculate the cost of 12% redeemable debentures. Now, to be able to calculate the cost of redeemable debentures, we use the approximate cost of debt formula for redeemable debt. So adjusted for tax, since the interest is tax deductible. So the formula after tax cost of debt will be so 1 plus R minus P over N over R plus P over 2 even this formula here supposed to be 1 plus times 1 minus T. That is the formula we are going to use. Now where the 1 minus D equals 2, this is what we call after tax cost of debt. Then the I equals to annual interest which is from we were given the annual interest is 12% of 1,000, because we were being told from the question above, we were told that the company also has a 12% of 1,000 redeemable debentures. So if you look at the annual interest, this is 12% of 1,000 shillings. If you do that, you calculate that, you will get 120 shillings. So let me remove that confusion. In our formula, the R is the redeemable value. Redeemable value. This is per share. The redeemable value we have been given is 1,000. P is the market price. This is the market price, which we have been given to be 1,200, and The N is the years to maturity. Years to maturity, which is 10 years. And then of course the T is equal to the corporate tax rate, which is equals to 30%. Corporate tax rate, which is equals to 30%. So if now we do our calculations. Now let's start by calculating the average annual capital loss. Let's start by calculating the average annual capital loss. So the first point is we are going to calculate the average annual capital loss. So that is going to be this is going to be the R minus P over N. So that is going to be the R we were given is 1000. Yes, P is 1200. So 1200 over N, which is 10 years. So if you do that, you will get negative 200. You'll get negative 200 over 10, which will be negative 20. Then let's check on the total return before tax. The total return before tax. So the total return before tax, if we quantify that, it's going to be 120 minus 20. So you get, this is like an I, it's not, this is not 1. So we calculated that, we got that is 120. So a positive plus minus, there's an alternative, it's a negative. So we have already gotten that. That is 120 minus 20 divided by 1000 plus 1200 over divided by 2 on that option. If you do that, you're going to get 120 minus 20, that is 100, divided by 1000, that is 2200, divided by 2, you will get 1100. So the answer will be, if you divide by that, you will get 0.0909, or in terms of percentage, that is going to be divided by 100 times 100, that is going to be 9.09%. So so we have that. Now if we can be able to get now the after tax cost debt, so we'll say KD equals to we have now we have calculated in that we have calculated already, we have gotten the total return before tax, that is percent. So we have that 9.09% times 1 minus 0.30 times 1 minus 3.930, if 1.0.3, that is the total tax rate. We will want to check on that. So you will get, this will be equal to that is 9.09% times 1 minus 30, that will be 0.7. So if 9% times 0.7%, 0.7, you will get 9.09 100 times 0.7, you will get 0.06363, which is equals, in terms of percentage, that is 6.363%. So the answer is 6.36. So our answer is 6.3. They calculate the cost of redeemable debentures, it's 6.3. That is how we do the calculations. Then number 33, calculate the market value of equity. Calculate the market value of equity. Now, for us to calculate the market value of equity, we have been given that the number of shares issued, from the information from the question, we have been told that the number of shares issued were 10 million. Per value of the share was 0.5 per value, and the current market price per share, that is cumulative dividends, was 2.25. Cumulative dividends was 2.25. So if we can have that information, so that we are going to use it. We have been given that the number of shares issued equals to 10 million. Then per value per share equals to 0.50. And then current market price per share equals to that is cumulative dividends, 2.25 shillings. So the concept of cumulative dividends versus X dividend price is that cumulative dividend is 2.5, which includes the right to receive the upcoming dividends of 0.25, and the X dividend price, this is price after the dividend is paid, so that's calculated as X dividends, cumulative dividends minus dividends. So that is 2.25 minus 0.25, you get 2. So we are going to use the X dividends. So for us to get the X dividends, we are going to take cumulative dividends minus dividends that we have been given. So what that means is equals to 2.25 dividends minus 0.25 that are given. So we will get the new cost to be 2.00 shillings. So why are we using the X dividend price? We are using that because the dividends that are given at 0.25 is a short-term liability and not part of the equity. The market value of equity should reflect only the residual claim of shareholders. So in our calculations, we are going to have the market value of equity equals to number of shares times X dividend price. Which is equals to the number of shares is 10 million that we have been given. The X dividend price is 2 shillings. So we will get our answer at 20 million. So that tells us that our market value of equity is 20 million. That is our option B. Now, number 34, calculate the market value of debentures. Calculate the market value of debentures. Now, we have been given that the nominal, that is the face value of debentures, is equals to, from the question, I have to go back to the question. We have been told that the company also has 12% 1,000 redeemable debentures with a nominal value of 9 million, trading at 1,200. So the face value of debentures is 9 million, and then the market price per debenture, here we have been told that they're trading at 1,200 shillings, and then the face value per debenture, we have been told that the company has also 12% 1,000 redeemable debentures. So the face value of the debenture is 1,000. So we have that information. So we have been given the nominal or the face value of the debenture being 9 million. Then of course we have the market price per debenture equals to 1,200 shillings, and then the face value per debenture equals to 1,000 shillings. So we need to determine the number of debentures. Now, when we are being asked about the number, of debentures, that equals to the total nominal value divided by the face value, the total nominal value divided by the face value per debenture. The total nominal value divided by the face value per debenture. So what that means is that our total nominal value is 9 million, while the face value per debenture equals to 1,000. So it means that we have 9,000 debentures. Now let's calculate the market value for the debenture. Let's calculate the market value for the debentures. Now when you talk about the market value, the market value of debentures equals to the number of debentures times the market price per debenture. So that will be equal to, we have gotten the debentures to be 9,000, so, and we have gotten the market price per debenture to be 1,200. So our market value for the debentures is 9,000 times 1,200. You will get shillings 10,800,000. So that is 10.8. 10,800,000. So our answer, if you look at our options, calculate the market value for the debentures, the answer is 10.8 million. That is the value for the debentures. Now question number 35, calculate the weighted average cost of capital using the market values. Calculate the weighted average cost of capital using the market values. Now, for us to calculate the weighted the weighted average cost of capital, we have been given the cost of equity. We need to get the cost of equity. We got that. The cost of debt. We have the market value of equity. We have the market. We need to get the market value of debt. Then we need to get the corporate tax rate. And all that. So in terms of calculating the cost of equity, because we have already done the calculations, if you check on question number 31, we calculated the cost of equity. We were asked to calculate the cost of ordinary shares. We got the cost of equity to be 19.25. And then when you talk about, we have that cost of debt in question 32, we were asked to calculate the cost of 12% redeemable debentures. We got that cost to be 6.36%. When we were told to calculate the market value for equity, the market value for equity in question 33, we have the market value for equity, which we got at 20 million. And also, question 34, we calculated the market value for debentures. The market value for debentures or the market value for debt, we got 10.8 million, 10,800,000. We were told to take the corporate tax to be like 30%. So we have our cost of equity of 19.25%. We have a cost of debt of 6.36%. We have market of equity to be 20 million. We have market value for debt to be 10.8 million. And then we have our tax, corporate tax to be at 30%. Now, if we calculate now the total firm value, we are now going to calculate the total farm value, that is V. So we are going to get that V equals to A, that is the market value of equity plus the market value of debt, which equals to 20 million plus 10,800,000. So the total will be 30,800,000. So let's determine the weight. Let's create more space. Now let's determine the weights. So weight of equity, that is the weight of equity, equals to the market value of equity divided by the market value of debt. No, the total divided by, divided by the total farm value that we have calculated. So that means that will be 20 million divided by 30,800,000. So if we calculate that, let me use my calculator. If we have that 20 million divided by 30,800,000, you will get that will be 0.6494. That is rounded off to 4 decimal places. So we convert, that is the same as 64.94%. So the weight for debt, equals to the debt divided by the total farm value, which is equals to 10,800,000 divided by 30,800,000. So you will get that to be 0.3506, which is the same as 35.06%. So let's now calculate the weighted average cost of capital. The question, weighted average cost of capital, like the question is asking. Now the weighted cost of capital, weighted average cost of capital equals to the weighted average, the weighted debt for equity times the cost of equity plus the debt for debt times cost of debt times 1 minus tax. On that perspective. So you have that. So this is going to be, of course, we have gotten the weighted of equity, that is 0.6494 times we got the total cost of equity to be 1925. so times 19.25% into brackets plus 0. We can take that 0.3506 times the cost of debt. We got it to be 6.36%. 6.36% into brackets 1 minus 0.3. So you have that like that. Sorry. So you're just creating more space. So what is going to happen here? Now let's do the calculations. 0.6494 times 0.1924. You calculate that, you will get 0.1250 plus 6494 times plus now 0.3506 times 0.0636 times 1 minus 0.3, that will be 0.7. 0.7, you will get 0.0156. So if you add 0.1250 plus 0.0156, you will get 0.1406. So if you change that into percentage, that is going to be or 14.06%. So that is the right answer. That is our weighted average cost of capital, 14.06. So from the options that we have been given, it's not there. So we have taken D because it's the closest, but the right answer is 14.06%. 14.06% is the weighted average cost. Now let's move on to another question. Question number 36. A company is deciding on whether to invest in a project that promises to pay 500,000 in 5 years. 500,000 in 5 years. The company's required rate of return is 10% per annum. What is the present value? What is the present value of this future cash flow? The company is deciding on whether to invest a project that promises to pay 500,000 in 5 years. The company's required rate of return is 10% per annum. What is the present value of this future cash flow? Now, to calculate the present value of future cash flow, we use the discounting formula. That is, present value equals to the future value divided by 1 plus the rate over n. That means that if I can give that, the F field stands for future value, whereas R is the required rate of return, and N is the time period. This is the time period. So our future value that we have been given from the question is that the company is deciding whether to invest a project promised to pay 500,000. So the future value we are looking here, it's 500,000 Kenyan shillings. The rate of return we have been told, the rate of return is 10% per annum. That is 10%, or it can be 0.1. And then we are talking about the time period. From the question, the time period is a period of 5 years. Here we are talking about a period of 5 years. Now, calculating our NPV, that is going to be, that means that it's going to be 500,000 divided by 1 plus 0.1 raised to a duration which is we have said is 5 years. Let me write this 5 properly. 5 years. So that is equals to 500,000 divided by, that is 1.01 raised power 5. So what you are going to get there, if we can compute, that is going to be 500,000 or over 1. This is 1. Don't get confused. 1 over 1 raised to power 5, that is 1. Sorry, this is 1.1, not 1.01. Check on that correction. This should be 1.1 raised to power 5. So 1.1 raised to power 5, that is 1.61051. So 500,000 divided by 1.6051, you will get 310,461. 310,461. So if we were looking at what is the present value for the future is 310. Our answer is 310,461. That is A, 310,461. Question number 37. Victoria Wanyala is comparing two investment options. Option A offers 10,000 shillings in 3 years, while option B offers 8,500 today. If the investor's discount rate is 7% per year, which option should the investor choose based on the time value of money? Victoria Wanyara is comparing to two investment options. Option A offers 10,000 shillings in 3 years, while option B offers 8,500 today. If the investor's discount rate is 7% per year, which option should the investor choose based on the time value of money concept? So to determine which investment option Victoria should choose, we need to calculate the present value of option A and compare it to the immediate payout of option B. So that means that the decision is based on the time value of money concept using the given discount rate of 5%. We have been given that option A is 10,000 shillings in 3 years, whereas option B is 8,500 shillings today. So the discount rate we have been told is 7%, or what we call 0.07. The time period we have been told is 3 years that we are looking for, or we are looking at. So just from the above question that we looked at, the present value equals to the future value divided by 1 plus the rate into brackets raised to power n, where our now future value is 10,000, our rate is 7%, and our time period is 3 years. So that means that if we compute that, that means that we have 10,000 is equals to 10,000 over 1 plus 0.07 raised to power 3, which means that this is 10,000 over 1.07 raised to power 3. If we calculate that raised to power 3, we are going to get that will be 10,000 divided by 1.07 raised to power 3, that is going to be 1.225043. So if we divide that, we are going to look at 10 divided by 1.283. we will get now the present value, which is 8162.98. the present value of the option is 8162, whereas we are being told that our current the option B is 8,500 today. The present value for project A is 8,000. The value of the present value is 8,162. So the best option is that the option we have given, option A, because 10,000 in 3 years is higher nominal value than 5,000 today. No. Option B is our right answer because the present value of 10,000 in 3 years is lower than that of 8,500 today. That is the best option. If you look at the other options page, so we will check on those options. Option A, because the present value of 10,000 3 years is higher than 8,000 today, doesn't make sense. So the right answer is option B, because the present value for 10,000 in 3 years is lower than 8,500 today, because we have found the present value for option A today is 8,162, whereas the one for the other project is 8,500. So they should invest in option B because the present value is higher of option B compared to the present value of option A today. Question 38. Peter Kimathi has deposited 50,000 in a savings account that offers an annual interest rate of 6%, compounded quarterly. What will be the balance in the account after 8 years? Peter Kimathi has deposited 50,000 in a savings account that offers an annual interest rate of 6%, compounded quarterly. What will be the balance in the account after 8 years? So what we are going to do to calculate the future balance for Peter Kimathi's savings account with quarterly compound, we will use the compound interest formula. The compound interest formula equals that A equals to P into brackets 1 plus rate over time over raised to power nt. Now what that means is that the P represents the principal. R represents the annual rate, and N represents the compounding frequency, and of course T represents the time. Now, if we look at our principal from the question, Peter Kimadi has deposited 50,000. So the principal here is 50,000. Account offers an annual rate. The annual rate is 6%. That is like 0.06. The compound frequency, we have been told that compounded quarterly, so the frequency is 4 times because that is quarterly in a year. So that is 4 times. And the time, what will be the balance in the account after 8 years? The time period is 8 years. So we will start by, let's divide the annual rate by the number of compounding period per year. Let's start by getting the, or in the applying of the formula is just like we are doing 50,000 plus into brackets 1 plus 0.06, that is the rate, over 4, which is quarterly. We divide by, we are going to take the rate that is 8 times 4. So that is 32. So that is going to be 50,000 plus 1. If you take 0.06 divided by 4, you will get plus 1 plus 0.015. 8 times 2, 8 times 4, it's raised to power 32. So that will be 50,000 plus that is 1 into brackets 1.015 raised to power 32. If you get that raised to power 32, that is 50,000 plus compute 1.015 raised to power 32, you get correction, this is times, not plus. This is times. This should be times. Point of correction. So 1.015 raised to power 32, we will get 1.61032. 1.61032. So times 50,000, 1.61032 times 50,000, we will get 80,516. 80,516. So from the options, 80,516, we don't have that figure there. We are taking 80,000 as the closest figure, but the right answer should be 80,516. Why the difference is there is because the option provided are pre-calculated with the price compounding. So you'll find that the options, like for example C, is incorrect because it's likely to assume monthly compounding or a rounding error. Option B is incorrect for similar reasons, and option D is underestimated for compounding interest. So this should be the exact answer in that calculations, but now you find that there's some small errors that affect that. Now question number 39. CIFA Limited is evaluating 2 potential projects. Project X will generate 2 million per year for the next 5 years, while Project Y will generate 2.5 million per year for the next 3 years. The company uses a discount rate of 8% based on the present value. for the cash flows, which project should the company choose? Now, to determine which project CFA should choose, we calculate the present value of both projects' cash flows using the discounted rate of 8%. So we have been given that project X is 2 million per year for 5 years. While project Y is bringing 2,500,000 per year for 3 years. So the discount rate is 8% or 0.08. So let's calculate the PV for project X. Now calculate the V for project X 5-year annually. So we are going to do it for 5-year annuity. For 5-year annuity. So the PV for project X 5-year annuity equals to, we are going to use the formula 1 into 1 minus 1 minus the rate minus n over the rate, close brackets. So where we are going to have the key is the annual cash flow, which we have been told is 2 million. Then we have the rate, which is 8%, or that is 0.08, and then we have n, which is 5 years. So if we calculate that, we are going to have, if we apply that formula there, that is PV for X, we are going to have 2 million times into brackets 1 minus or over 1 minus this is supposed to be plus, not minus. 1 plus the rate is 0.08 and we are talking about the duration to be 5 years. So minus that 5 over 0.08. So you divide by that. So we have 1 plus 0.08 that raised to power -5, you will get 0.68. So that will be 2 million times into brackets 1 minus 1.08 raised to power 5 divided by 0.8. So that is 2 million times into brackets 1 minus, if you raise that power, you will get 0.680583 over 0.08 and all that. So 1 minus 0.8, so that is 2 million times 1 minus 0.680583, we will get 0.319417 divided by 0.8. So if we do that, we will get, that is 2 million times 0.319417 divided by 0.08, you will get 3.99271. So which means that the present value is 7,985,420 for project X. Now number 2, let's calculate the present value for project Y, that is in a 3-year annuity. 3-year annuity. So we are going to do it just like we have done the other one. So in this project, you will find that the cash flow that we have been given here is 2,500,000, and the annual is 3 years. Of course, the rate is still 8% or 0.08. So if we use the same formula, we are going to have 2,500,000 into brackets 1 minus 1 plus 0.08 raised to power negative 5 over 0.08. So if we do that, that is 2,500, 2,500,000, 2,500,000 times into brackets, that is 1 minus. So if we have that as 1.08 raised to power negative 3, you will get 0.793832. 0.793832 over 0.08 of that. So we'll get, that is 2,500,000 times, if we do 1 minus 0.793832, we will get 0.206168 over 0.08. So that will be 2,500,000 times 0.206168 divided by 0.08, that will be 2.57710. So 2.57710 times 2,500,000, we will get 6,442,750. So we have in that part we have the present value for project X, and we have the present value for project Y. The present value for project Y is 6,442,750. The present value for project X is 7,985,420. 985 420. 7,985 420. So the conclusion is that the project X has a higher present value of cash flows deposit despite its lower annual payments present. So in if we go back to our question, if we are looking at the option that we are given, project X, because you should choose project X because the total cash flow of 5 years is higher than the discounted. No. Project Y because the present value of 2.5 million for 3 years at 8% is higher than the present value of 2 million for 5 years at the same time. No. Project X, which is the right option, project X because the present value of 2 million per year for 5 years is higher than the present value for project Y, even though its annual cash flow are lower. So because we have found that the present value for project X is 7.9, while the present value for project Y is 6.4, then you should choose project X because the present value is higher compared to the present value for project Y. So that is it. That is from question 30 to 30.